2005, Mauritius suffered a double whammy economic shock, losing its preferential trade agreements for its sugar and textile industries. And so it had to come up with an innovative solution, and it decided to turn the island into a financial services hub. But how did it do this, and how does it plan to survive the global slowdown?
We had survived basically as part of the European Union's arrangements with the former Commonwealth countries, which was sort of building up on the Commonwealth Sugar Agreement, built up into the Lomé Convention. So we were surviving on that. And of course, we don't know what hit us the day that particular agreement was declared to be non-WTO compatible. So the day we had to dismantle all these preferences, in particular for sugar, for example, and for favored access for textiles and others to European markets, quota access. So when all these had to go, we had to become more market friendly, we had to become more competitive, we had to become more productive.
Basically what we did was a couple of things. First, we radically transformed the way business is carried out in our country by improving the ease with which you do business and by lowering the costs of doing business. We rationalize many legislation and incentives and consolidated everything into one solid legislation with a level playing field. Second, we have opened up the country to the world in terms of attracting talents, ideas, innovation, and technology. And the third thing we did was to simplify the taxation system. We had a very complicated tax system with a lot of carve-outs, many allowances, many deductions, and it was not leading to an efficient allocation of resources. So we took a very bold decision. We abolished most of these allowances and deduction, we removed most of the carve-outs, and we adopted a single rate of taxation across the system. 15% corporate tax, 15% personal income tax, and 15% VAT.
Mauritius fought back, ignoring critics and putting its energy into convincing investors to move their businesses here and of course making Mauritius an offshore investment hub. Now the financial sector contributes 12% to the country's GDP.
The financial services sector in Mauritius has come a long way over the last 15 years, and this has been essentially driven by the fast growth of the real sector of the economy, and this has created a conducive environment to, financial product innovation, creation of new institutions, and the setting up of the stock exchange, in fact, fits very well within this change that has characterized the Mauritian economy over the last 15 years. So, as far as the stock exchange is concerned, we started our operations in 1989 as a very small pre-emerging stock exchange with 5 listed companies, and we at some point in time, 3 or 4 years down the road, we already had some 20 companies listed. And other than the stock exchange, I think there's been a lot of developments in the financial services sector in general. We are one of the leading offshore centers in Mauritius. We are used more and more as one of the main conduit to India in terms of FDIs. We've attracted a lot of foreign names into Mauritius.
Like other countries, Mauritius's financial sector has felt the effects of the global economic crisis as investors pull their money out of emerging economies. And now, as world leaders come together to try and make sure this doesn't happen again, measures are being put in place to make tax havens more transparent and regulated. But the government of Mauritius insists the island is nowhere near that blacklist.
You can't have 12% of GDP with people, local Mauritians, not being involved. So I think that the fact that exchange control was abolished since 1992, we haven't seen any sort of capital flight and all of this stuff. What we have seen is that people investing massively into their own country. Really, I think, is a show of strength of how we have been in a position to develop an industry from nowhere, out of nowhere. There is now a pool of talent in the country. There's a pool of talent that has been developed having been engaged on the international scene since the early 1990s. And today, we are doing a lot of very sophisticated work. There are over 600 funds based in Mauritius with a total net asset value of over $60 billion pre-Lehman. Now we have to understand in terms of valuation what that means, but still, just to give you an idea, we've got 34,000 companies registered in the International Financial Center of Mauritius. So I think we could have been 400,000, we could have been 500,000, but the point is it's well regulated. We want to do serious business. Mauritius is no sunny place for shady people.
But despite good reforms, nothing could really account for the global financial crisis that's catapulted the world into the worst economic situation since the 1930s. And for the first time in history, the Bank of Mauritius has had to offer two of the country's major banks a lifeline.
In our economy, we have two local banks which are quite large in our import and export trade. And one of those banks came running to us that their foreign currency lines had been cancelled by their correspondents who had been dealing with them for donkey's years. And nothing had changed in Mauritius. That bank is very solid, strong fundamentals, like all our banks here. There's no problem here. There's no sign of toxic assets. But banks overseas became nervous and they cancelled these lines. Now, if we did not do something about it, our whole import and export trade could have ground to a halt, at least those that were going to these two domestically owned banks. Foreign banks with their probably had their own relations still open. So we thought that we have to do something about it. It was ridiculous that central bank keeps reserves in New York and London and Brussels or wherever it is, Paris. Those reserves are passed on indirectly to some banks, who in turn give it out to others and partly to our own bank. So we thought we could take part of those reserves and give it straight to our banks, because we were going to do a better service to the economy by making it available instead of running the risk of trade grinding to a halt through lack of financing. So we stuck our neck out. First time in the life of this bank, we provided a hefty foreign currency line, much bigger than the market required. And very quickly after that, the foreign currency lines from foreign banks were restored.
And Mauritius Commercial Bank, which is the largest company by market cap on the stock exchange of Mauritius, says the banking sector is liquid.
The $125 million US dollar credit facility is very much a backstop. It's a fallback facility for the banking system here. As you know, one of the features of the banking crisis around the world has been the reduction in trade finance facilities, country limits, interbank lending. And therefore, banks have had to fall back very much on corporate, institutional and retail deposits. But I think that the Mauritian banking system has a strong dependence on deposits, which is a good thing, and very little dependence on what is called this interbank or wholesale funding. So whilst the Bank of Mauritius has made available this credit facility, I don't think it's actually being used very much, if at all, but it is there as a buffer should the need arise.
There is talk that the JSE, which is Africa's largest stock exchange, has put in an offer to buy a 49% stake in the Stock Exchange of Mauritius. This was at first rejected by the Financial Services Commission, forcing the parties to go back to the drawing board. At the time of broadcast, no one was willing to comment on any new developments.